Now in this morning's U.S. Bank Economic 360, we're talking about a subject many of us have dealt with or are dealing with: student loan debt. In recent years, it has skyrocketed due to the high cost of college and relatively stagnant wages. While many still see a college degree as a worthy objective, the cost of attaining one has pushed many families to the limit. U.S. Bank investment analyst Jim Russell joins us with some new perspective. Jim, good to have you with us.
Good morning, sir.
All right, so some of us have gone through this. We've experienced it. And we're seeing that the prices are rising so rapidly. There's so much of this debt out there. Is this the new debt bubble we face as a country?
We think we would stop short of that kind of designation, Brian, but it is clearly a major event for many families out there. Student loans in the United States have reached the $1 trillion mark, which is easy to understand given the fact that a cost of 1 year of college in a public institution now is over $11,000 per year, and the cost of a private institution over $34,000 per year. So while the debt of households have come down in many other categories, credit cards, mortgages, other installment debt, actually households have seen an increase in student loan debt over the last 5 years.
$1 trillion in debt. Now, does that have an effect on the overall economy, do you think?
Absolutely it does. The statistics point that out pretty clearly. In fact, for 40% of those who have a student loan burden after they graduate from college, they have statistically delayed a purchase of a home or a car. 27% of them have returned home to live with their parents, and 14% have delayed marriages. So what we've done is put together a couple of other statistics that I'd like to maybe turn to and have our viewers reference here for just a second. And what you'll see on this is that, as you'd mentioned, the proposition for college remains a very high value proposition. It is almost assumed that a college education is necessary to compete in today's environment. Student loan debt now exceeds credit card debt, as just mentioned, and those growth rates continue to move a bit higher. We have a second set of statistics also that I'd like our viewers to take a look at. 2/3 of 2010 graduates have loans, and those loans averaged over $25,000 per person. So we're talking about some pretty big numbers there. Student loan debt has doubled since 1989 as well.
This does not take into account graduate level debt.
Correct, which would be incremental to these numbers that were just shown.
Yeah, and a lot of people are finding that a degree gets them nowhere without a master's or even a doctorate, so we have that to deal with. So inflation's been relatively low lately. Has this college debt, has it exceeded the inflation rate, the growth of the debt that's out there?
I think a lot of people probably assume that it probably has. Let's take a look at what the facts say. And what you'll see here on this graph is fairly astonishing in my opinion. You'll see on the purple line at the bottom, the inflation rate is right around 70–71% since 1990. What you'll see is the cost of public education at college is over 3 times the inflation rate from 1990 through current. And you'll see that the private education is just below that as well. So by far, the cost of college has indeed exceeded the inflation rate. And as you'd mentioned in your opening remarks, it has exceeded by far average wage gains as well. This is why student loan debt continues to mount and, again, be a problem for many families out there.
Yeah, some troubling stats. Thank you, Jim. We appreciate you and U.S. Bank.
Thank you, sir.